Welcome to the debate. Today we're dissecting a decision that, well, it really makes or breaks any commercial expansion into the Middle East, the architecture of corporate jurisdiction in the United Arab Emirates. The UAE offers this really seductive proposition to global business. You've got political stability, world-class infrastructure, a dollar-pegged currency, and it's a strategic bridge between East and West. But beneath the polished surface of this pro-business environment lies a real labyrinth of mainland, free zone, and offshore structures. The central tension we're exploring today is between what we'll call business reality, how a company actually captures revenue, and compliance reality, what regulators and, crucially, banks demand to even let you exist.
It's good to be here. And you frame that tension well, though, maybe a bit politely. I'd argue the conflict is really between the marketing fantasy of a tax-free, instant setup haven that founders get sold on social media and the cold, hard machinery of global banking compliance. We are witnessing a massive structural shift in the UAE. The era of the paper company, just setting up a license to hold a bank account, that's dead. The question isn't, where can I legally register? It's become, where will the global financial system allow me to operate?
That is the crux of it, exactly. And that brings us to our core disagreement for today. So I'm representing the revenue-first strategy. My belief is that jurisdiction is a tool for market access, not just a compliance box to tick. If you prioritize administrative convenience or cost savings over operational flexibility, you basically strangle the business in the crib. You have to map the revenue model first, who pays you, where are they located, what's the service, and let that dictate the structure, even if it's a bit harder to set up.
And I'm taking the compliance-first position. I argue that the perfect commercial model is utterly useless if it cannot transact. The landscape is frankly littered with companies that optimize for revenue flexibility or some market theory, but failed because they couldn't satisfy the strict demands of banks regarding substance, audits, and source of funds. My argument is that risk mitigation and banking acceptance are the primary drivers of jurisdiction selection. If the bank says no, you don't have a business. You just have a very expensive piece of paper.
Okay, let's get into the mechanics then. My starting position is that any decision-making has to begin with the commercial truth of the enterprise. You just cannot look for the cheapest license or the one that promises some 24-hour digital setup. The source material is very clear on this. The structure has to align with how the business manages its counterparties. For example, if you're a management consultant and you're primarily serving clients in, say, Berlin or London, your needs are radically different from an electronics trading company importing goods into Dubai for re-export.
I don't disagree that the model matters, but I think you're underestimating the friction involved in that choice. You talk about needs, but often founders conflate needs with wants.
Let me finish the thought because the nuance here is key. If I'm that consultant, what I need is clean international invoicing. I don't necessarily need a physical shopfront in Daira. But if I am that electronics trader, I need logistics-friendly zones, I need customs codes, and perhaps I need mainland access to contract directly with local suppliers. If I choose a jurisdiction based on ease of setup, let's say a cheap creative license in some remote free zone, rather than my revenue capability, I end up with a company that legally cannot execute its core function. The revenue-first approach says, define the customer, define the transaction flow, and then pay whatever price is necessary to make that flow legal and frictionless.
I see why you prioritize the commercial flow. I do. But you're talking about the theory of business capability. I'm talking about the gatekeepers. And the gatekeepers are the compliance officers at the banks and the tax auditors. You mentioned the consultant serving UE clients, okay? If that consultant sets up a company that looks light on paper, a cheap license, no resident visa, no physical office, no real local operational expenditure, because they think, oh, I'm just emailing clients, they are going to hit a wall.
You keep mentioning this wall. Be specific. What does that look like practically?
It looks like a declined notification from the bank's onboarding team. Banks evaluate applications through a lens of risk, specifically AML or anti-money laundering protocols. They look at substance. And in the UAE context, substance, well, it isn't some vague term. It's a legal concept tied to economic substance regulations, or ESR. It asks, does this entity actually do work here? Do the decision makers reside here? Is there a physical footprint? If the bank sees a disconnect between your, say, high-volume revenue projections and your flexi-desk reality, they see you as a shell company. Founders constantly underestimate the severity of these recurring obligations. They buy the license, thinking they're done, but they haven't budgeted for the reality of maintaining that existence.
I think we need to ground this in the actual structural choices available, because that's where the confusion really starts for most people. We have three main buckets: mainland, free zone, and offshore.
Yes, let's dig into that, because this is where the cheap option usually ends up destroying the business.
Right. So from a revenue-first perspective, the mainland structure is often the only viable choice for a serious business, yet so many people avoid it because they fear complexity. To clarify, a mainland company is an onshore entity registered with the Department of Economy and Tourism, or DET, in the respective emirate. Historically, this required a local sponsor who held 51% of the shares, but we need to update our listeners. Recent laws have opened this up to 100% foreign ownership for most commercial activities.
It's a game changer, yes. But that doesn't remove the regulatory burden.
No, it doesn't, but it removes the main barrier to entry. Mainland companies can operate across the entire UAE, they can contract directly with local entities, they can bid on government tenders. If you're a consultant who wants to bid on a project with a government ministry, or you're a construction firm, or a restaurant, you can't hide in a free zone. You need to be mainland. You need to be where the economy is actually happening. That is revenue access.
That is true, but you're glossing over the operational weight of the mainland. It is significantly heavier. Mainland implies much tighter regulatory oversight. You're looking at specific office leasing commitments. The AJARI, which is the registered tenancy contract, you generally can't use a virtual office for a mainland license effectively if you want to pass a rigorous bank inspection. You're subject to the Ministry of Human Resources and Emiratization, MOHRA labor laws. This means wage protection systems, or WPS, for employees. For a massive corporation, fine, but for a digital marketing agency or a SaaS startup, mainland is often just overkill.
Is it overkill or is it future-proofing?
For a lean startup, it's waste. This is exactly why free zones exist. A free zone is essentially a designated jurisdiction like the Dubai Multi-Commodities Center, DMCC, or Dubai Internet City that operates with its own regulations. They're ring-fenced. A software firm billing global subscriptions doesn't need to be dealing with municipal approvals or MOHRA in the same way a restaurant does. They need a specific license type that matches their activity, probably in a tech-focused free zone. My issue isn't with mainland. My issue is with the misuse of offshore entities.
I suspect we might find some common ground on offshore.
The source material is pretty brutal on this. When we say offshore in the UAE context, we usually mean RAK ICC or JAFZA offshore. These are international business companies. They are strictly for holding assets or for international trading where goods do not touch UAE soil. They prohibit commercial activities inside the UAE. Yet how many times do we see founders trying to use an offshore vehicle to run an active consulting business just because it was cheap?
It happens constantly. They see the price tag, maybe $2,000 or $3,000, and think they've somehow hacked the system.
And it's a disaster. Banks hate it. If you're an offshore entity with no physical presence, no visa eligibility, because generally offshore doesn't grant visas, and you try to open an operating account to receive client funds, you are immediately red flagged. You have zero substance. You can't trade locally. So from a compliance-first perspective, offshore is almost never the right choice for an operating company. It's a holding tool, and that's it.
I agree with you there. The revenue-first model rejects offshore for operations because it limits who you can sell to. You can't legally invoice a local client in Dubai from a RAK ICC entity. That's a revenue blocker. But let me push back on your defense of free zones. You mentioned the software firm. Yes, a free zone sounds easier, but the source material notes that free zone companies often face limitations on the ground.
Such as?
Well, if that software firm suddenly decides to sell hardware components, or it needs to deploy a team on-site at a client's office in Abu Dhabi for a 6-month integration project, they hit a regulatory wall. A free zone license technically allows you to do business within the free zone or outside the country. To trade with mainland UAE, you strictly speaking need a local distributor or you have to open a branch office. Suddenly, that simple free zone setup requires a second entity. Now you have 2 sets of books, 2 audits, 2 license renewals. If they had just gone mainland from day one, they would have absorbed the complexity up front but secured total market access.
That's a compelling argument for scalability, I admit. But have you considered the cash burn? You're asking a startup with 0 revenue to take on a physical office lease, which in Dubai is traditionally paid by annual checks up front, just in case they might need to trade locally later? That's just poor capital allocation. But let's pivot to the mechanism that actually kills these companies. We've talked about the license, but the license is just the ticket to the dance. The real bouncer is the bank. You mentioned earlier that banking is just about the narrative. I find that incredibly optimistic.
I didn't say it's just a narrative. I said it's about a coherent story. The source material suggests creating a bank readiness file. This isn't just filling out a KYC, I know your customer form. It's about proving the commercial validity of the business.
And what does that entail, in your view?
It means you walk into the bank, or more likely the digital onboarding portal, with proof of funds, a realistic business plan, and actual client contracts or letters of intent. The bank wants to see decision-making capability in the UAE. If you have a professional website that reflects your licensed activity and you can show that the management actually resides here, the banking friction decreases. My argument is that banking failure isn't usually because the jurisdiction is wrong. It's because the founder failed to present a professional, cohesive business case. They look amateur.
I'm sorry, but I just don't buy that entirely. A coherent story doesn't fix a structural mismatch. You're treating compliance officers like they're investors who care about your pitch deck. They're not. They are risk auditors who care about checking boxes on an algorithm. The bar for substance is much, much higher than you're implying.
Okay, give me an example of where a good story fails.
Certainly. Take a high-volume trading company. They set up in a free zone designed for media or creative arts, let's say, one of the Northern Emirates free zones, because the license was cheaper and didn't require an office. They get the license, they go to the bank. The bank sees a general trading or e-commerce license in a zone known for media, but the invoices coming in are for shipping containers of electronics or raw materials.
That's a clear mismatch.
It is. But founders do it because the license definitions are broad. The bank denies the account. Or worse, the account opens and 3 months later, the transaction monitoring algorithm flags a payment. The compliance team audits the file, sees the mismatch between the license activity code and the customs codes on the invoice, and they offboard the client. Account closed. You have 30 days to move your money. That is a compliance reality. No amount of storytelling is going to fix the fact that your license doesn't match your trade.
That's a fair point, but that actually supports my revenue-first argument. You just described a business that prioritized the cheap license over their actual activity. If they had focused on their revenue model, I trade electronics, they would have chosen a logistics-friendly zone like JAFZA or a mainland license, and the bank would have been fine. We're actually agreeing here. The mismatch is the killer.
We're agreeing on the symptom, but not the cure. You think the cure is strategic alignment. I think the cure is overcompliance. I argue that even if you have the right license, if you rely on flexi desks, these shared workspaces often used just for the license registration, you're at risk. Banks are increasingly demanding physical offices for certain types of accounts, especially trading. They want to see that you aren't just a letterbox. And this leads to the topic nobody wants to talk about, the money.
The costs.
The true costs, not the sticker price you see on the website.
I view costs as necessary investments in infrastructure.
That is very easy to say when you're well capitalized. But I focus on the hidden expenses that bleed these businesses dry. The source material lists them clearly. License renewal, visa processing fees, medical insurance, which is now mandatory in Dubai, Emirates ID fees, but the big ones are corporate tax and VAT.
Correct. Since June 2023, the UAE has a 9% corporate tax on profits above 375,000 dirhams, plus the standard 5% VAT.
Exactly. So a founder looks at a spreadsheet and sees license, 15,000 dirhams. They think that's their cost. They don't budget for the professional support needed to maintain audit-ready records from day one. If you are a software firm, you might think you're small. But if you fail to register for VAT because you didn't realize your turnover crossed the mandatory threshold, which is 375,000 dirhams in revenue, not profit, the penalties are severe. 10,000 dirhams for late registration alone. These penalties can instantly outweigh any savings from that cheap setup.
I accept that. But I would frame it differently. These aren't hidden costs. They are the costs of doing business in a mature economy. The UAE isn't a Wild West tax haven anymore. It's a Tier 1 jurisdiction. My argument is that spending more upfront on proper governance, on shareholder agreements, dual approval for payments, prevents internal disputes later on. The source mentions that strong governance supports clean audits. If you treat these costs as investments in scale, you build a company that can actually be sold or receive investment. If you treat them as nuisances to be minimized, you just build a house of cards.
But you have to survive long enough to scale. Let's look at asset protection. This is where I think your revenue-first strategy can be dangerous if it ignores the compliance layer.
I disagree completely. Asset protection is a strategic revenue enabler. The source material explicitly discusses holding structures. If I have a software company, I should not keep my intellectual property, my source code, my brand trademarks in the same entity that faces liability from clients. I should separate them. I use an offshore entity or maybe a distinct free zone entity, like a foundation in ADGM, the Abu Dhabi global market, to hold the IP or real estate. That is just a smart strategic move. It isolates risk. If the operating company gets sued, the assets are safe.
It is smart, conceptually, but practically, it can create an integration nightmare if you aren't careful. A holding structure is useless if the operating company can't execute the day-to-day. You mentioned software. If that operating company is handling cross-border client data, they have data protection obligations, GDPR in Europe or the UAE's own data protection law. You can't just say, oh, the holding company owns the IP and ignore the fact that the operating company is processing personal data.
That's a valid operational detail, but it's solvable.
That's more than a detail. It's an entire layer of compliance complexity. And consider the money flows. If your operating company pays royalties to your holding company for the use of that IP, that is a related party transaction. Under the new corporate tax regime, you have transfer pricing rules. You have to prove that the price you're charging yourself is an arm's length market rate. Suddenly, your smart strategic move requires a sophisticated tax study to prove you aren't just shifting profits to avoid the 9% tax. The compliance-first reality is that complexity multiplies with every new entity you add to the organizational chart.
That's true. Transfer pricing is a real burden now. But consider the alternative. Keeping all your assets in a single basket where one lawsuit could take down the IP, the cash, and the brand? I would much rather pay for the transfer pricing study than lose the entire code base.
Source material has a very ominous line. An abandoned company creates lasting compliance shadows.
Yes, the importance of clean closure. This is something people almost never think about when they're starting.
Precisely. Many founders who realize they chose the wrong jurisdiction, maybe they went free zone when they needed Mainland. They just walk away. They stop renewing the license. They leave the bank account open with a zero balance. In many countries, the company might just dissolve. In the UAE, this is a catastrophe. You accumulate monthly penalties, you can get blacklisted at immigration, the banks will mark you as a defaulter if fees pile up.
Which just reinforces my initial point. If they had chosen the right jurisdiction based on their revenue model in the first place, they wouldn't have to abandon the company. They would be growing it. The failure to launch is almost always a failure of alignment. They tried to hack the system with a cheap setup that couldn't support the business, and when it hit the wall, they ran.
Or they simply underestimated the compliance load. They thought they could run $1 million business with a flexi desk and a spreadsheet, and the bank shut them down. They didn't realize that flexi desk meant they couldn't easily get a tax residency certificate to show to their home country's tax authority.
We're circling the same drain here. It seems we both agree that the era of the paper-only company is well and truly finished. The days where you could fly in, sign a paper, get a bank account, and fly out to run the business from a beach in Bali they're largely over.
So let's try to bring this to a conclusion. I'll let you summarize your position first.
My position stands. You cannot hack the UAE system anymore.
The choice of jurisdiction is actually a choice about how much compliance load you can handle. If you cannot afford the office, the staff, the audit, and the proper visa structure, you are perhaps not ready to operate in that specific way. The so-called hidden costs, VAT, corporate tax, economic substance reporting are the real killers. My advice is to assume the bank is looking for a reason to say no and build your structure to give them absolutely no ammunition. Do not overreach on complexity if you can't support the substance.
And I see why you prioritize safety, but let me give you the revenue-first perspective to close. Compliance is the baseline, it's the floor, not the ceiling. The strategy is the driver. The structure must support the revenue. If you're a trading firm, you need logistics-friendly zones or mainland access. If you're a government contractor, you need mainland. You cannot compromise on the legal ability to do business just to save on administrative headaches. The right jurisdiction is the one that aligns with the actual business model, not the one that looks easiest on a spreadsheet. If you build for compliance but you block your own revenue channels, you've built a very safe, very compliant failure.
And I think we can converge on one thing the source material makes very clear.
Go ahead.
Whether you're focused on aggressive revenue growth or defensive risk mitigation, the requirement is disciplined records from the first day.
Absolutely. Treating banking and compliance as integral to the business, not some afterthought. The days of fake it until you make it with corporate structure are over. You need to be audit ready, bank ready, and operationally sound from the moment you print that trade license.
And perhaps that's the ultimate takeaway. The UAE is open for business, but it's only open for real businesses.
A fitting end. Thank you for listening to this deep dive into UAE corporate strategy. We hope this illuminates the path between ambition and reality.
Thank you for joining the debate.
Until next time.